Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're taking a look at a name that's seen a lot of volatility, Nebius Group.
And if you find our talks useful, please consider hitting that subscribe, like, and comment button underneath. It really helps us out.
It does.
All right, so let's get into it. Nebius Group. I have to admit, when you first look at the chart for this one, it's a little scary. A lot of red.
Oh, it's more than a little scary. It looks like a falling knife on the surface. But, that's exactly why we're doing this deep dive.
Because sometimes the ugliest charts hide the biggest opportunities.
Exactly. There's a real disconnect here between the price action and, well, what all the analyst commentary is saying. And that disconnect is where things get interesting.
Okay, so let's start at the very beginning. What is Nebius? I hear AI infrastructure, and my mind immediately goes to the big players, the AWS, the Azures of the world. Is Nebius just a smaller version of that?
That's the key question. And no, they're not. That's the most common misconception. They aren't trying to be a generalist cloud provider.
So they're not hosting, like, company websites or email servers?
Not at all. Their focus is much, much narrower. They are a vertically integrated AI infrastructure platform.
Vertically integrated. Okay, unpack that term for me. What does it actually mean in this context?
It means they control the whole stack. So a normal cloud provider, they might just rent you some server space. Nebius, on the other hand, builds its own proprietary GPU cluster hubs.
So they're building the data centers from the ground up.
From the ground up. They're optimizing everything. The hardware, the software that sits on top of it, even the cooling, it's all in-house R&D.
Which gives them a competitive advantage, a moat.
A huge moat. Because when you're running these massive multi-million-dollar AI models, efficiency is everything. You can't afford the kind of overhead you'd get from a generic one-size-fits-all cloud.
I see. So the specialization is the key. But what about the customers? What stops a startup from using Nebius for one project and then jumping to a competitor?
Well, that's where the ecosystem comes in. They create what you could call an ecosystem lock-in.
Lock-in sounds a little sinister.
It's more practical than sinister. They partner with research institutes, finance, healthcare, even national AI programs. Once you build your entire workflow on their specific optimized architecture,
moving becomes a massive headache. The switching costs are too high.
Exactly. It's just not worth the effort to save a few percent. They're selling a platform, not just reselling chips.
Okay, that makes sense. Strong business, high-tech moat, sticky customers. But we have to talk about the chart. We're recording this on February 6th, 2026, and the stock is down, 30% from its highs? That's not a dip, that's a crash.
It's been brutal. There's no way around it. But the key here is that the selling seems to be driven by fear in the sector, not a problem with Nebius itself.
So it's guilt by association.
It really looks like it. We have to talk about what happened with iron.
Iris Energy.
Right.
They reported earnings yesterday, and it was not good.
Not good is an understatement. Down 11% in one day after a big earnings miss. And in a sector like this, an earnings miss spooks everyone. The immediate reaction is, oh no, AI demand is drying up.
So investors just sold the entire basket of AI infrastructure stocks.
The algorithms definitely did. But here's the crucial difference the analysts are pointing to. Nebius is not iron. Their business models have a fundamental difference in risk.
And how's that?
It all comes down to revenue visibility. The sources suggest Nebius has these hyperscaler contracts locked in.
Meaning contracts with the really big tech companies.
The biggest. And these aren't month-to-month deals. These are major long-term commitments for capacity. It de-risks their execution profile massively.
So while other companies might be chasing customers day to day, Nebius already has its revenue for the next year or so, basically guaranteed.
That's the thesis. So selling Nebius because iron missed is, well, it's mispricing the risk entirely.
Which brings us to valuation. If the price falls 30%, but the revenue is still there, the stock just got a whole lot cheaper.
A whole lot cheaper. And this is where the numbers get really compelling. Right now, Nebius is trading at under 2.8 times forward price to sales.
Under 3 times sales. For an AI company, that sounds incredibly low.
It is. It's way below its peers. A multiple that low is usually for a company that's in decline, not one that's in a massive growth phase. Analysts are calling this a capitulation-driven entry point.
Capitulation. So the last of the weak hands have finally given up and sold their shares.
That's the idea. The panic sellers are out, and it's all happening just before a huge catalyst. It's a classic pre-earnings dip. The market has been driven by fear, not by math.
Okay, let's talk about that catalyst, the event on the calendar.
Market down. Next Thursday, February 12th. Nebius reports its Q4 earnings.
Less than a week away. What are the expectations? Because if they pull an iron, this thing could go even lower.
The expectations couldn't be more different. The word analysts are using is explosive. Explosive revenue growth for Q4 and for the full year 2025 guidance.
Explosive is a strong word. Why are they so confident?
It comes down to something called capacity ramp acceleration. Basically, Nebius has been spending a ton of money building out all this infrastructure,
Right.
and Q4 is when a lot of that new capacity finally came online. They flipped the switch.
The factory is built, and now the assembly line is running at full speed.
You got it. But it's not just about Q4. The market's going to be obsessed with the future, with guidance. And that brings us to the Vera Rubin.
I saw that in the notes. What is the Vera Rubin?
It's their next generation GPU offering, the Vera Rubin NVL72 launch.
NVL72. For those of us who aren't hardware nerds, what does that mean? Just a faster chip?
It's more than just a chip. Think of it as an entire server rack that acts like one single giant GPU. It's an architecture built for the biggest, most demanding AI models.
The ones that the biggest companies and countries are trying to build.
Exactly. And by launching this, Nebius puts itself right at the cutting edge. It expands their market to clients who need that absolute top-tier performance. And it helps drive what the reports are calling regional AI cloud adoption.
Okay, regional AI cloud. Why is the regional part so important? Can't you just access a server anywhere in the world?
You can, but there are two problems: speed and sovereignty. Sometimes the speed of light is still too slow, but the bigger issue is data sovereignty.
The idea that countries want to keep their own data on their own soil.
Precisely. Governments, banks, healthcare systems, they are getting very nervous about their sensitive data sitting in a data center in another country, subject to another country's laws.
So Nebius is positioning itself as the partner for this sovereign AI movement.
That's the geopolitical angle. They build the high-tech, compliant infrastructure locally.
Which has to cost a fortune, all that capital spending.
It's incredibly capital intensive, and that's a key thing to watch in the earnings report. The cash flow will be under a microscope.
But the theory is they're spending that money against the contracts they've already signed.
That's the whole thesis. They are building against known demand, not just hoping customers will show up.
So with all this going on, what is the smart money doing? Are the big funds buying this 30% dip?
The consensus seems to be a firm yes. One analyst summed it up with a great line: ignore the volatility, follow the capacity.
I like that. Look at what they're building, not the squiggly red line on the screen.
Pretty much. The general view is that the correction was a massive overreaction. In fact, some contributors on Seeking Alpha are calling for a potential 44% upside going into this earnings print.
44%. Wow, that's a bold call. Where does that number come from?
It's basically a mean reversion play. It assumes the sell-off was driven by sector panic, and that after a strong earnings report, the stock should re-rate back to its previous multiples. It gets you right back to the recent highs.
And are we seeing big funds put their money where their mouth is?
We are. The reports mention funds like the Alger Small Cap Focus and their growth funds have positions.
Alger is a serious name. They're long-term investors.
Right. It suggests growth-focused managers are using this panic to accumulate shares at a discount.
Okay, I have to play devil's advocate. This sounds almost too good to be true. What's the bear case? How does this all go wrong?
There are two big risks. The first is pure execution risk.
Meaning they just can't get the job done.
Or they can't get it done fast enough. If Nebius comes out on February 12th and says, yeah, demand is great, but we had supply chain issues and our new capacity isn't online yet.
The market will crush them.
Absolutely. The stock would retest its lows in a heartbeat. They have to deliver.
And the second risk?
Valuation compression. The macro risk. Even at a cheap 2.8 times sales, if there's a broader market crash or if the whole AI sector rolls over.
It doesn't matter how well Nebius performs. A falling tide lowers all ships.
Exactly. You could have a great report and the stock could still go nowhere. You can't fight the entire market sentiment.
Sobering thought. Okay, so we've covered the business, the sell-off, the catalyst, the sentiment. Time for the verdict. Give me a score.
Weighing everything up, the deep discount against the very strong fundamentals and the near-term catalyst, I'm giving this a bullish score of 8.5 out of 10.
An 8.5. That's high conviction. You really think the market has this one wrong?
I think the setup is incredibly compelling. You have a high conviction story that's been sold off because of fear, not facts.
So how should someone think about this? Is this a quick trade or a long-term hold?
I think it can be both. For a shorter-term trader, there's a swing trade opportunity here to capture that potential 44% upside into the earnings call.
Betting on that snapback rally.
Exactly. But for the longer-term investor, this looks like a chance to buy a core AI infrastructure holding at a deep discount. You buy it and hold it for 2+ years to ride the wave of AI capital spending.
The digital picks and shovels play.
That's the one.
You know, the final thought I'm left with is that sovereign AI concept we touched on.
It's a powerful theme.
If data is the new oil, then the infrastructure to process it is the new pipeline network. And countries are realizing they need to own their own pipelines.
They need intelligence independence.
Exactly. And if Nebius becomes the go-to company to build a nation's own AI brain on its own soil, under its own laws, that makes them a strategic asset.
And strategic assets are valued very, very differently than regular tech companies.
It's a fascinating angle that the market might be completely ignoring right now. Something to think about as we wait for Thursday.
It's going to be a very interesting week.
Well, that's our deep dive on Nebius Group. We hope that helps you sort through the noise. We'll be back again soon. Thanks for listening.